Hey everyone, welcome back to Corporate Decoder. Today, Synchrony Financial just filed an 8K revealing new preferred stock details, and I am seeing a significant shift in their capital structure. Quick note, this is not financial advice, just my take on public filings for educational purposes. The company is issuing new preferred stock, adding another layer to their financing. And we need to understand what this means for common shareholders. Synchrony Financial, you know them as SYF that is traded on the New York Stock Exchange, is adding more classes of stock to its name. They have common stock, and now they are expanding their preferred stock offerings even further. You might remember them from their Series A and Series B preferred shares that also trade on the NYSE. So what is the big news here? Synchrony Financial is issuing new preferred stock, specifically Series C. They are selling what they call depositary shares, and each one represents a small piece of this new Series C preferred stock. Think of it like buying a fraction of a share, but for this new preferred stock. This happened quite recently on the 5th of June 2026. The company officially filed the paperwork to create this Series C preferred stock on the 4th of June. This new stock has a dividend rate of 7.250%, and it is fixed rate reset, meaning the rate can change over time. It is also non-cumulative perpetual preferred stock, which means if they miss a dividend payment, they don't owe it later, and it can stay outstanding indefinitely. Now here is a crucial part for anyone holding common stock of Synchrony. This new Series C preferred stock comes with some restrictions. If Synchrony Financial doesn't pay the dividends on this Series C preferred stock, it can actually stop them from paying dividends on their common stock or any other preferred stock that ranks lower than Series C. This means common shareholders or lower tier preferred shareholders could see their dividend payments halted if the company struggles to pay this new preferred stock. The creation of this Series C preferred stock is officially an amendment to Synchrony's main corporate charter. It is like adding a new rulebook for this specific type of stock. To get these new shares out there, Synchrony signed an underwriting agreement back on the 2nd of June. This agreement was with big names like BofA Securities, Barclays Capital, and Morgan Stanley. They acted as the underwriters, which means they helped Synchrony sell these 500,000 depositary shares to the public. This whole process was done under a registration statement they had already filed, so it was a planned offering. This underwriting agreement is the formal contract detailing how the shares will be sold. It outlines the terms, the price, and the responsibilities of both Synchrony and the underwriters. It is a critical document for understanding the mechanics of this new stock issuance. This is the official document that defines everything about the Series C preferred stock. It lays out all the rights and preferences, including dividend amounts, voting rights, and what happens if the company goes through liquidation. It is the legal blueprint for this new investment instrument. This agreement explains how the depositary shares actually work. It is between Synchrony, a company called Computershare, which acts as the depositary, and the people who buy the depositary receipts. Computershare essentially holds the actual Series C preferred stock and issues these depositary receipts to investors who buy the depositary shares. This is what an investor would actually receive to show they own a piece of the Series C preferred stock. It is the tangible evidence of their ownership in these depositary shares. And of course, to make sure all of this is above board, Synchrony Financial had their lawyers Sidley Austin LLP provide a legal opinion. This is standard practice to confirm that all the legal requirements for issuing this new stock have been met. So, looking at this filing, what does it tell us? Synchrony Financial is actively managing its capital structure. By issuing new series of preferred stock, they are likely seeking to diversify their funding sources or perhaps meet specific capital requirements. However, for common shareholders, the key takeaway is the potential impact on dividends. The restrictions tied to the Series C preferred stock dividends could mean that for common shareholders, their income stream might be the first to be cut if the company faces financial headwinds. This is a common trade-off with preferred stock. It often offers a more stable dividend to its holders. But it comes at the expense of flexibility for common equity. It is not uncommon for companies to issue preferred stock to shore up their balance sheet, especially in the financial services sector where capital adequacy is constantly under scrutiny. Think of it like adding another shelf to your financial house and making sure that shelf is well supported before letting anyone else use the space below it. My biggest concern is how this incremental layer of preferred stock will affect the company's ability to return capital to common shareholders in the future, especially during uncertain economic times. The risk I am watching is how readily the company can maintain those Series C dividends, as any miss directly impacts the common stock. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded. If this analysis was valuable, hitting that like button really helps. And subscribe for more deep dives. Don't forget to check out the Discord in the description.